The RRSP/RRIF meltdown strategy is a tax-efficient way to convert your registered assets like your RRSP and your RRIF into non-registered assets using an investment loan. This strategy effectively helps you manage your taxes better by getting an interest deduction on your taxes through this investment loan and offsetting that deduction against your income from the RRSP or the RRIF withdrawals. You then take those funds that you withdrew from your RRSP, your RRIF, and use that to pay the interest portion on the investment loan you've taken out. This is the meltdown strategy in a nutshell. And in this video, I'm going to walk you through how the strategy works, is it right for you, and what are the risks involved before you take on this strategy. So let's dive right in. Some influencers in Canada will claim that this is an absolute tax-free strategy to withdraw money from your RRSP. But essentially, all you're really doing is getting an interest expense deduction, and you're using that deduction to offset income from the RRSP. Now, oftentimes when you're using the strategy, and if you use it correctly, it can result in a tax-free withdrawal, but there are definite risks involved before you implement the strategy for yourself. This strategy critically relies on you getting an interest expense deduction on your taxes. Now, if the government in power or the Department of Finance decide to change those rules, well, this strategy comes crashing all the way down. This is a crucial element of the strategy. This strategy is definitely not for everyone. It is not a blanket strategy at all. This is only for those that I would recommend if you have a high risk tolerance, you have a decent amount of investment time horizon, at least 10 years you're looking at, and you are comfortable taking out a loan and using that loan solely for investment purposes. Now let's really dig in and understand how the strategy actually works. But before you can talk about the meltdown of the RRSP, you have to understand how the RRSP actually works. So here's the RRSP in a nutshell. The RRSP allows Canadians to defer taxes on their retirement savings. When you make a contribution to an RRSP, you are allowed a tax deduction for the year you make your contribution, because effectively, you are reducing your gross income for the tax year. As you reduce your gross income with an RRSP deduction, that effectively reduces your tax liability. And tax on the earnings of your RRSP are deferred until you actually withdraw money from the RRSP, meaning the funds or whatever you've invested inside the RRSP grow on a tax-free basis up until you get to a point where you've contributed enough, and now you're at a stage where you want to start taking money out from the RRSP. You only pay taxes at that point. When you withdraw money from your RRSP, it increases your taxable income for the year, and that income is taxed at your marginal tax rate. If you don't have a spouse or a common law partner, the entire fair market value of your RRSP is included on your tax return upon death, and it is taxed at the highest marginal tax rate. Essentially, this gives the government of Canada their final last opportunity to grab a piece of your income before you pass on. Now that you understand what an RRSP is and how it works in terms of contributions and taxes, at the withdrawal stage, this is where the meltdown strategy kicks in, because what you're aiming to do is create something called tax neutrality. As I mentioned, when you withdraw money from your RRSP, you are taxed at your marginal rate. With this strategy, you are taking out an investment loan. That investment loan allows you to deduct the interest on your taxes. Effectively, that deduction will cancel out the income, creating that tax neutrality. The point is that your interest expense deduction is going to be equal to your RRSP withdrawal. Now, in order to actually get this interest expense deduction, when you take out this investment loan, you actually have to use it for investment purposes, such as investing in dividend-paying stocks, or maybe you invest in guaranteed income products. Either way, that investment is generating some cash flow. And it's that nature of the income generation through the investment loan that allows you to actually deduct interest on your taxes. Now let's go through an example to actually put the strategy into context, because if you're like me, sometimes the theory makes more sense when you actually see the math behind the numbers. So in this case, let's take out a $50,000 investment loan, and let's assume the interest rate on this loan is at 6%. That means this loan will require a $3,000 annual interest payment. Now, after you take out that loan, the proceeds are used directly to invest in a non-registered portfolio. Effectively, a non-registered portfolio is anything that is not a TFSA and not an RRSP. Effectively, it's when you say non-registered, it means anything that is not tax sheltered. So you're going to use that loan and you're going to use it to invest in a non-registered portfolio. Keeping in mind, the main idea and the goal of the strategy is to offset our income inclusion with the interest cost deduction. So in this case, we're going to withdraw $3,000. Because we have a $3,000 interest expense, they effectively cancel each other out. In theory, if you really think about it, all you're really doing is you're going to replace your registered funds with non-registered funds on a tax-free basis. It sounds simple, but there are a lot more factors involved that you need to be aware of, which I'm going to cover next. Now let's talk about the risks involved when you implement a strategy like this. First of all, it all hinges on the interest rate that you're going to get on your investment loans. So in our example we just talked about, the interest rate was 6%. That means you want your investment portfolio to generate at least a yield of 6% at least. So that way it's spitting off enough cash flow to cover off your interest expense. So that way you're not left with negative cash flow. And before diving into a strategy like this, you also have to assess how comfortable are you with taking on risks. Because anytime you use borrowed money to invest, there's going to be some inherent risk you're willing to take. And if you're not comfortable with that type of risk, then you really want to stay away from the strategy completely. So if you really think about it, going back to our example, we took out a $50,000 loan to invest into a $50,000 investment portfolio in a non-registered account. Now what happens if that non-registered account value goes from $50,000 to let's say $30,000 because there's a huge stock market crash? And now you're like, I need to sell this portfolio, and you sell and you only get back $30,000. Well, the investment loan that you took out was $50,000, and by selling your investment portfolio, now you only got back $30,000. So you're really in the hole for $20,000. Now, the more money you borrow, the greater the risk, right? You really want to stay out of this type of trouble and have to understand the types of risks involved. Now, on the flip side, we took out this $50,000 loan. We have a $50,000 investment portfolio and it goes up in value. That's all great. But what if the yield on this investment portfolio is less than the interest rate on the loan? What if it's only yielding 3%? That means the income that this investment portfolio is spitting out is not enough to cover the interest payment. So now I have to figure out, okay, what other source of cash do I have to cover my interest expense? The other thing you want to think about with a strategy like this is what is your investment time horizon? Meaning, how long are you willing to keep this investment loan outstanding? How long do you want to have this money invested in the market? If you're going to use something like this, I would definitely recommend at least an investment strategy for a minimum of 10 years. Why? The longer your investment time horizon, it increases the chances for your investment portfolio to grow and surpass the value of your investment loan. Plus, it also reduces volatility. The longer your investment time horizon, the less volatility you will face over that long-term period. The other risk you want to consider, and this one is often not talked about from other influencers, is when you take out an early withdrawal from your RRSP, that means you're no longer contributing to the RRSP. Remember, the whole point of the RRSP is that it allows you to defer taxes on your investments until you're ready to withdraw. And with the strategy, you are effectively giving up your ability to make that tax deferral because you're effectively transferring funds from this RRSP or this RRIF into a non-registered account. You're effectively saying that I don't need this tax deferral anymore, and I'm going to now grow it on a non-registered basis. If you're going to have a fairly long withdrawal period, I would definitely recommend you consult with a professional to see if the numbers actually make sense for you to actually implement the strategy. Remember, once you withdraw money from your RRSP, you can't recontribute that money back. That contribution room is now gone and lost forever. And the other thing to keep in mind is that if you're going to take out a lot of money from your non-registered portfolio, and if your income is going to be that much higher, you may trigger OAS clawbacks, and you don't want to be in that situation, especially in your retirement years. So that's what I mean. If you're going to implement a strategy like this, you need to really run your numbers to see if the scenarios make sense based on your investment horizon, based on your goals, based on your risk tolerance, So definitely 100% consult a professional before you take on a strategy like this, because there's so many risks involved and you don't want to really screw up your retirement savings because you make a mistake in the strategy. It could cost you hundreds of thousands of dollars. So be very careful with a strategy like this. Get professional advice. Now that you've understood how the RRSP works, how the Meltdown strategy works, who it's for, the behind the scene risks involved in implementing a strategy like this, the last piece I want to leave you is with some caveats on the strategy. Because if you don't understand full and well everything involved with the strategy, like I said, you could be risking your entire retirement savings nest egg, and you definitely don't want to do that. Firstly, what is the purpose of the investment loan? The investment loan is central to this Meltdown strategy. By borrowing to invest, you can potentially increase your investment capital and the benefit from tax deductions on interest paid. Next is the interest payment itself. The interest on the investment loan should be paid with the withdrawal from your RRSP or your RRIF. This aligns the strategy with the tax regulations involved, allowing the interest to be deductible. That's the whole point. You want this interest to be tax deductible, which then offsets your taxable income on your withdrawal from the RRSP or the RRIF. Next is a tax deductibility concept. The interest on the investment loan needs to be tax deductible. And in order for that to happen, the borrowed money must be used to earn income such as dividends or such as interest from investments. This is a requirement, and this ensures the strategy is actually tax efficient. Otherwise, you're doing a whole lot of stuff for a whole lot of nothing. Next up, let's talk about the marginal tax rate. If the current tax rate is not much lower than your expected tax rate at death, this strategy is not beneficial. So I wouldn't even consider using a strategy like this. When it comes to your time horizon, a longer time horizon increases the chance of your investments growing to cover the loan and the interest costs. If you expect a long deferral, leaving funds in the RRSP is actually better. The next thing I want to think about is having surplus cash flow. You have to ensure that you have enough non-registered funds on hand to make principal repayments on this investment loan you just took out. And you want to have enough cash flow, because what if the interest rate you took out actually goes up? We've seen post-COVID that interest rates went up and now they're coming back down. So you want to make sure you have enough cash flow that if the rate of borrowing goes up, you can still cover the interest expense. And not only that, but what if your investment portfolio actually drops in value? You still have to pay back the loan. You have to make sure that you have enough cash to cover the interest and the principal repayments. Investment risk tolerance, because anytime you're going to borrow money to invest in anything, that is inherently going to increase the amount of risk you have to take and the amount of risk you have to be comfortable with. If you're not at all comfortable with borrowing money for investment purposes, again, this strategy is not for you, plain and simple. The last thing to consider is the impact on retirement, because this strategy effectively replaces your registered assets intended for your retirement with non-registered assets, and that could impact your retirement expenses. Making early withdrawals from your registered plans can also impact income-tested benefits like OAS, old age security, so you want to avoid OAS clawbacks. The RRSP/RRIF is a tax-efficient strategy, and if used under the right circumstances, it can be fairly tax-efficient, but it should only be used by those who are either in retirement or near retirement. And like with anything, any strategy you talk about that could make something more tax-efficient, there's going to be some inherent risk that you have to take in order for it to become more tax-efficient. Because otherwise, everyone would be doing it, and I'm pretty sure the government would change rules if everybody started to make things more tax-free than it was intended. The way I think about this is that if I'm approaching retirement, or if I'm already in retirement, I'm going to have a fairly low risk tolerance, because again, I've spent many decades building up this golden nest egg. Do I really want to risk it all to save a bit on taxes? Maybe, maybe not. But more often than not, you're going to be in that, I don't want to risk my retirement nest egg, And I'm okay paying a little bit more taxes because I'd rather keep that money, because if I lose that money, then I'm really in trouble. And if you have a shorter time horizon, because again, if you're already in retirement, maybe you don't have 10, 20, 30 years to take on additional risk. So those are all the things you have to consider with a strategy like this. With anything when it comes to personal finance, investing, you have to do your due diligence, because no one is going to care more about your hard-earned dollars than you will. And if you spent decades building up your investment portfolio, do you really want to take on, additional risk? Because there is a sense of taking risk to build up that capital. But once you have that capital built, you really want to be on capital preservation mode rather than taking on additional risk. Something to think about. Weigh the pros and cons, see if those things make sense for you. That goes with anything on personal finance. Always weigh the pros and the cons together to see if options A, B, or C make more sense or not. That's all I wanted to talk about on this strategy. Please do stay connected with this channel. If you found this video helpful, make sure you hit subscribe at the bottom of this video. Give it a thumbs up so I know you want to see more content like this. And please, if you can, hit that thanks button. It just gives that extra bit of support to this channel, to the content I create. Lastly, please check out all the links in the description down below. It's a good way to support this channel if you are able to, and I super appreciate any little bit of support on this channel, because that support allows me to keep making more videos like this. That's it for now. I'll talk to you in the comment section.